Did you know it's one ratio or one mathematical problem that can help you make money with your stocks? Doesn't matter what the market's doing and which stock you're in. If you use this ratio, this gives you the ability to almost predict how much money you can make. That, my friends, is the risk-reward ratio. So we're going to talk about what risk really is from an investment standpoint, how we can eliminate the risk when we invest, and most importantly, how can we turn that risk into reward? Are you ready? You ready to go over risk, de-risking your portfolio, and making money with the least amount of risk? If so, then you're in the right place. But before we get started, as always, like, subscribe, and share to the channel. I'm a certified financial planner in real life, blessed to help thousands of people nationwide, but on these social media airways, where my 100,000 followers on YouTube. Thank you. We're here to give information, not recommendations, because I'm a fiduciary. We're here to give information that's going to help you transform your finances and, most importantly, build wealth. You ready? Let go.
And you just wanna get paid, tired of making no money mistakes. Make a payment on your bills and you still late, yeah. Pay for profits to help you seek change, and you just wanna get paid, yeah. Tired of making no money mistakes. Make a payment on your bills and you still late, pay for profits to help you seek change, yeah. Cut the show and just listen. You wanna feel empowered by making money decisions. Residual by the hours can get you a better living. Bitch at the check, you knowing it could be different.
So what actually is investment risk before we go over the risk-reward ratio? Well, per Google AI, they're not paying me, by the way. They're not paying me, but per Google AI, investment risk is the probability of likelihood of losing money or achieving lower than expected returns on investment. Basically, how likely are you to lose money? The higher the risk, theoretically speaking, the higher the reward. The lower the risk, theoretically speaking, the lower the reward, right? So if we're in riskier investments, we should, theoretically speaking, have a better chance to make money, but then also a better chance to lose money. The flip side, if we are in a low risk environment, then it's a likelihood that we probably won't lose money, but it's also very highly that we're not going to make any money either. Right? Key elements to risk: capital loss, the possibility of losing part of all of your original money. We get it all the time from our clients. Hey, Mario, I want to make money in the market, but I don't want to lose. So theoretically speaking, that's not a lot of risk. But then when you go over the investments, it's not going to make you a lot of money. You say, whoa. I can't have my money in the CD. I can't be in no savings account. I need to make money. So your risk tolerance, or how much risk you can take in, is really higher than what you think. You guys think about it, right? Wouldn't you love to make all the money in the stock market and never lose? Risk. But the potential of capital loss is the reason why a person is risk averse, or they don't want to invest in money. That's where the risk reward ratio comes into play. But we'll get there. Underperformance, which is the chance that the actual returns fall short of your target, right? So if we are low risk and we're not making as money as what we want, we're falling short. So it's like a double-edged sword, because I'm not risking as much. That might be good. But on the bad part, I didn't make any money and I wanted to make more. That's why the risk reward ratio is so key. Is it just me, or is that you're working hard, but you're not seeing the financial results that you want? We're clocking in, we're clocking out, we have the income, we're making the money, but our wealth is not growing like we want it to. Well, my friends, it's not your fault. You know why? Because we're never taught how money works. We're taught how to spend it, but we're not taught how to leverage the money that we're making right now to build wealth. Now, wealth, it comes in all different shapes and sizes. The question is, how much wealth do you want for you and your family? But the best part about it is help us on the way. Join us during our 5-day mentorship, where you learn how to structure your money, reduce your tax liability, increase your net worth, and build wealth. We'll show you how to go from a wealth builder to a wealth strategist to a wealth creator, and leaving that long-lasting legacy to your family. Click the link below and join us on our 5-day mentorship, where we'll help you accelerate your wealth. Now back to the episode. Also, volatility, the frequency and size of price fluctuations in the market. We all know the market fluctuates. It goes up and down. And with AI, with these bots, algorithmic trading, it's only going to be more fluctuations, right? Usually, bad news, market goes down by 0.5, 1%. Now, bad news, the market might go down by 3 or 4%. Good news, the market's going to shoot on up. So the wavelength of volatility is more. But as an investor, if we're low risk or even high risk, this is an opportunity to take advantage, because if we have those huge swings on a downturn, we can buy things at a lower price. Things are high on a high turn, we can then sell an investment that's a little bit too high using the risk-reward ratio, which we'll talk about here shortly. And oh yeah, finally, the risk-reward trade-off. Higher potential returns generally require taking on higher risk, but it's a ratio, and this ratio goes over how much risk you will take per the reward you're going to get. So the risk-reward ratio measures the potential profit of an investment relative to its potential loss. It helps investors determine if the potential return of a trade justifies the financial risk that you take. So can you justify taking more risk? Well, if that ratio is in your favor, then yes. If the ratio is not in your favor, probably not. So how it works? First, it's a calculation. First, you divide the potential loss, which is your risk, by the potential profit, which is your reward. So again, we divide the risk by the reward. So let's say the risk is $100, but the reward is $500. That means it's a risk-reward ratio of 1 to 5, right? We have the possibility to lose $100 or the possibility to make $500. So 1 to 5 odds. Not a betting person, but I think those are pretty good odds, right? Are they? Y'all let me know in the chat. The ratio is expressed by two numbers separated by a colon, not a semicolon. So in that example, 1, semicolon, 5. The first number is the risk number, the amount of money that you stand to lose if the investment goes wrong. The reward is the second number, the amount of money you expect to make if the trade succeeds. Scenario again. We'll do it one more time for you guys, as you know everything, right? The purchase price of the stock is $100. Okay, so I'm buying one share of something for $100. Let's say we buy a stock for $110, right? $110. One share is $110. And we have a stop loss price. The risk, right? Because when we invest, we want to have a stop loss, right? So basically, if it goes down, prices are going to sell to make sure that we don't continue to lose money, a stop loss. So you set a limit for $10, meaning that I don't want to lose no more than $10. If I put 110, I don't want to lose no more than 10%. So going from 110 to 10. So your loss potential is $10, right? That's my potential loss. I'm not going to lose any more. On the left-hand side, $10. But then on the right-hand side, we have our take profit or our reward. So using that same example, you set a target if it goes up to $210. And that $210 means a gain of $100, right? So our profit or our reward is $100. So we would take the $10 of potential loss by the $100 of potential reward. So I'm risking $10 to having a reward of $100. So my risk reward ratio would be 1 to 10. Are you like the 83% of Americans who want to get a trust, who want to get a will, want to get a power of attorney, but you don't have one? Well, you are not alone, because 22% of Americans have one. That means 1 out of every 4 families have a trust, a will, and a power of attorney. Which bracket are you in? 1 out of 4 or 3 out of 4? It's okay, because we have the Relax Estate, a fully automated AI platform that allows you to create a trust, a will, and a power of attorney all at the fingertips. And if you are an insurance agent, tax professional, financial advisor, notary, or in any business profession, you can even white label this to your clients. You grow your business, you help your clients, everybody wins. Visit our website, www.therelaxestate.com. Right here, therelaxestate.com, and you can create a trust for your family, or if you're a business owner, want to use it to scale your business and help your clients, you can do that as well. Now back to this wonderful episode. So for every $1 I could lose, I'm going to make $10. You understand that, right? So I'm risking $10 to be rewarded for $100. Very, very easy concept, but this concept allows you to dictate before you make an investment, doesn't matter what your risk is, conservative, aggressive, moderate, balanced, growth, you already know before you invest your money, how much are you willing to lose? On the flip side, how much are you willing to make? And that goes a long way when it comes to investing your money properly. So again, pretty easy. So the question is, what should be my risk-reward ratio? Well, from a long-term investment standpoint, now, past performance does not guarantee future results. Nobody knows about the future, and this is just information, not recommendation. But long-term, a risk-reward ratio of 1 to 4 is pretty good, right? I'm willing to risk $1 to make 4. Index funds, SPY, QQQ, DIA, IWM. Those will get you those types of risk reward ratios, right? Also, as well, depending on the price of that investment goes a long way. The same investment worth $200 compared to the same investment that's down worth $150, you're going to get a better risk reward ratio when that stock is at $150 compared to $200. That's on the investment side long term. But then we have our traders. And our traders, they're the ones that get it wrong the most because 90% of traders lose. You're like, what? You hear all these great success stories on YouTube, on Facebook, on Instagram, on TikTok. 90% of traders lose because you're going against everybody else, right? You're going against these big old banks. You're going over the algorithm. The algorithm always wins. The banks win. So risk reward, if you're doing options, I would say, not recommending, I would say a risk reward ratio of 1 to 20. That means for every $1 I invest, I expect to make $20 back because you're going into something that has a historically 90% chance of not making money because most day and swing traders lose more than what they make. Day and swing trading. Long term, different story. It's the opposite. If you just hold something for 3, 5, 10 years, you should be in good shape, especially if it's an index fund. You should be in good shape. Should be. Stocks, depend on what you pick. But from a day trading standpoint, I like that risk reward ratio of 1 to 20 because I give myself a super duper duper chance of making money and I help my probability because of that 1 to 20. That means I'm trading, finding things that are deeply, deeply, deeply discounted. Something that's failed like crazy and using the chart from a support standpoint. If we're doing calls, if we're doing puts, using that chart resistance standpoint. What's the call? What's the put? Well, think of it like a phone. Join us in our school community as we have modules, classes, courses to go from a taxpayer to a wealth builder. How to use our cliff, dip, bear strategy to do better with your investments. How to acquire businesses and how to use your retirement plan to grow and not pay taxes. What? I can have our retirement plan grow and not pay taxes? Yes, your IRA or even your 401k at your employer. This and other things we focus on in our school community, the Relax Investor. And guess what? You get 7 days, free access, and you get our weekly coaching calls every Wednesday. You and hundreds of people ask questions to 6, 7, 8, and even 9-figure business owners that tell you how they created their business, how they run their business, and how their finances is as smooth as it can be. So click the link below and join us in our Relax Investor Academy to help you scale your finances. I got my phone. If I pick it up to call, that means I'm buying a call because I think the market's going up. I pick it up to call. And then think of a phone. When I'm done, I put the phone down. Put the phone down, which means I think the market's going down. So when I buy a put, I think the market's going down. So when you talk about your support, that means it's going down, but I think it's going to bounce back up. That's a call. If I think about a put, it hit resistance and it's going to go back down. So I'm putting down the phone. But it's not an options conversation. Even though I'm a certified financial planner, this is a risk reward. So use this when it comes to buying stocks and indexes long term, but definitely use this ratio when it comes to doing your day trading or your swing trading. Now, will this guarantee that your stock selection is going to be correct? No, nothing's guaranteed, and nobody knows the future but God. But this risk reward ratio goes a long way with you knowing exactly how much you're going to risk, knowing how much you can make, and then allows you to decide very, very quickly, is that investment or that trade worth the risk? And that, my friends, is how we make passive profits. So hopefully this was great from an informational standpoint, but let me know, what other indicators do you use? Do you use something else besides the risk reward ratio? Do you use something else? Is there other indicators? Do you use moving averages? We're here to give information. I'm a certified financial planner. So since I'm a CFP, we help clients with stocks, with real estate, and decreasing your taxes because I'm certified to do it. So this channel gives you so much information. And that's why I want to thank everybody again for allowing us to hit the 100,000 subscribers. I couldn't do it without you guys. But click the link below, smash that like button, give me a hype, share it, give it to your friends so they can learn about the risk reward ratio. They can be educated like you did. And when we do that, love is love. We all made some painful profits together, y'all. You guys be blessed. Peace.